Te daré mi devoción para siempre poderoso. I asked Jobu to come. I offer him cigar and rum. He will come.
Hey guys, Rafi here from the Endgame Investor. Hanukkah is over. I got my Hanukkah present. It was an Austrian school t-shirt from my wife. When your wife knows your school of economics and that your YouTube shirts suck, it's like a double hot.
We have a very healthy relationship. I see.
Anyway, today we're going to go into why I think the bottom in gold is in, and it's from some obscure reason that frankly, I don't think anyone's ever heard of, including myself, until I just found it. And also that the rate of deflation continues to accelerate. The money supply is shrinking at rates that have never been seen before in monetary history, as far as we know, US monetary history at least. And yes, the Fed keeps losing more and more money. And when central banks lose money, it's very bad for fiat currencies.
It's very bad to steal Jobu's rum. He's very bad.
And I have about 20 minutes until I have to pick up my daughter from kindergarten, so let's get this video going. And so the first slide I wanted to share with you on this little PowerPoint presentation that I concocted in the tradition of Spartan design is the follow the money, housing bubble, or currency bubble chart. Sometimes we lose sight of the fact of what is the money in the equation here. The entire world has lost sight of that fact for quite some time now, but it doesn't change the fact that gold is money and the dollar or the pound or any other currency is merely a money substitute. What is a stark proof of this? It is this very simple chart from the 1968 fall of the London gold pool. The blue line is London housing prices in pound terms, pound sterling, the UK fiat currency of choice. And in the yellow line is those same real estate prices in gold ounces. What is the bubble here? Is it real estate prices or is it the pound itself? Of course, it is the pound itself. Gold is money, the pound is a money substitute, and everything that follows pound prices is in a bubble because the bubble itself is the currency. That is what's being printed. You cannot print housing, you can print money substitutes. And now what happens on the way down when money substitutes are no longer being printed? This is the US money supply. The M2 line is in blue. You can see here from 2008 until 2020, the COVID lockdown printing madness. The money supply pretty much went up in a uniform fashion, and the NASDAQ here, the ultimate, not the ultimate, but a pretty good measure of stock bubbles, goes along with the money supply pretty uniformly. In addition to here, during the COVID lockdown printing, I will not say pandemic because it had nothing to do with any disease. It had to do with the policy response to it. You see that along with the money supply, which skyrockets in about 2 or 3 weeks, eventually the stock prices, the bubble stock prices catch up. And here we have the peak of the money supply in April 2022, and ever since then it has been falling faster than it has ever been falling since 1971. And now you see, as the dollar bubble deflates, you have stock prices deflating as well. Now, yes, consumer prices will also eventually deflate if this is the trajectory that the money supply will go in for years at a time. Then yes, consumer price inflation will stop and eventually reverse. But what reverses first? What has the strongest correlation with the money supply? Is it consumer prices? No, the direct correlation, or a more direct correlation, is stock prices, which topped just before the money supply topped itself and has been falling ever since and will continue to fall as long as the deflation rate continues as it is going. And as long as they keep raising rates and no more QE, then it will continue to fall. And this is not the end to a stock bear market until the Fed releases its final pivot, at which point gold and silver will rocket much faster than the stocks, these bubble stocks, will. Now, this correlation that I'm going to show you is something that I found. It doesn't mean that it is authoritative or that I have any special insight into the inner workings of the magic monetary system today. It is something that I think is intriguing. And you know what? In a retrospective study after the end game hits, we're all going to be like, oh my God, why didn't I see that? It was that. That was the ultimate indicator. If only I'd follow that, I would have known that it was going to happen XYZ date, and I could have been a millionaire because I could have bought all these options and timed it perfectly. We're never going to know, and it's going to be obvious in retrospect.
You know when you hear girls saying like, I was so face last night, I shouldn't have that guy. We could be that mistake.
But for now, here is what I see, and I think it is very interesting. This is a chart from the 2001 gold bottom at 255 on February, I believe it was February 16th, 2001 when gold hit. I believe it was 253. I could be wrong on those numbers, but it doesn't really matter. So gold bottoms at about $253 an ounce on February 2001. This other line here is the CRB, and it bottoms in late October 2001. So the space between that, gold bottoms first and then commodities. They have a 9-month buffer between them. First gold bottoms, then commodities, and a 9-month space between those bottoms. That is the final gold bottom of 2001, and that began the great gold bull that continues to this day with little bear markets in between. That's true. Now, here's the next major bottom in gold. It happened on October 31st. That one I'm sure about. October 31st. October 24th, I'm not sure about it. It doesn't matter. The 2008 gold bottom happened in the last week of October 2008 at, I don't remember, 630 something, whatever it was. And you have the CRB, the consumable commodities index, bottoming in February of 2009. So you have, let's say, November 2008 to February or March 2009. That is about 5 months, 4 to 5 months bottom. So first we had a 9-month buffer, and now we have a 5-month buffer. It is shrinking between these bottoms, but still gold is first, and then you have commodities. Now you have the 2015 bottom, which was the bear market bottom in late 2015 when gold bottom at 1045. So you have here that bottom on December 5th, I think, of 2015. Gold bottoms here in that first red circle, followed by the CRB General Commodities Index bottom in February of 2016. That is a 3-month buffer, 2 to 3 month buffer. It gets even shorter. Every time there is a major bottom in both gold and commodities, the bottoms get closer and closer together. And now here you have the 2020 bottom. This was March 16th with gold at 1450. And here you have the, this is the April 20th CRB bottom. I remember it was April 20th because I wrote an article about, oil hitting negative $35 a barrel and everybody on, weed on 420 thinking, oh, I think gold's going to hit negative 35 a barrel. I'm so stoned, but it actually happened. This was about let's say a 6-week buffer between the gold bottom and the CRB bottom. They get closer together at that bottom. And I have 2022, something happened here. Here is the gold bottom, the CRB bottom on September 25th, 2022. And here on November 5th, 3rd, whatever, is 1618, the gold bottom that is still intact. We are here now at around 1823, a little bit lower today. December 27th, 28th, whenever you're watching this, I'm sure that 16.8 bottom is still holding. This is the first time since the gold bull market began in February 2001 that the CRB bottomed ahead of gold. Now, what does that mean? Why is that relevant? Well, according to my shirt, which says Austrian School of Economics, and I should have like a superhero costume. She could have given me a superhero costume. That would have been super hot. But, I can't really walk around in that. That would just be strange.
There's a new group of superheroes in town, and we're...
Quiet! It's 4 a.m. and I just fell asleep for the first time in 30 years!
Anyway, how would Austrian School Economics teach or apply significance to the fact that first gold bottoms before commodities, and now all of a sudden commodities is bottoming before gold with an ever decreasing buffer between the two bottoms? Well, when the inflationary engine starts, the inflation goes into the banking system and is far away from the consumer sector, but it affects the monetary sector. And what is the commodity that is most affected by the monetary conditions? Not necessarily consumer price conditions, But monetary conditions in the banking system, that is gold. So you would expect when the inflation is still high up in the structure of production, not affecting the consumer sector directly, then there should be a long lag between a gold bottom and a consumable commodities bottom, which is what we saw in 2001. And as the inflation gets closer and closer to the consumer sector, you would expect the bottoms to come closer and closer and closer together until you get to 2020 when the bottoms are almost coinciding. Why? Because the money printing of 2020 had to all go almost directly to the consumer sector. We had consumer level bailouts of people, of the government giving consumers money to buy food and pay their rent or whatever because they were on lockdown because we had to save the planet, which we did, thank God. Everything was great. It was great. And the bottoms came almost simultaneously at that point. But now the bottom in 2022, the first time that consumable commodities, which are heavily correlated with the consumer sector, they bottom first. That means possibly that the inflation is affecting the consumer sector before it's even affecting, or even more greatly than it's affecting, the monetary sector. And that will lead to a bottom in consumable commodities before the gold sector is infected or affected by the change in monetary conditions. Now, during the end game, when the public picks up on this, just because commodities are bottoming first now does not mean that commodities prices are going to rise faster than gold prices. Because when people hoard, yes, they hoard all kinds of commodities, they hoard all kinds of things, they hoard food, they hoard valuables or whatever. But the most efficient thing to hoard in a time when money substitutes are dying is gold and silver itself, because they store the most value and they are the most liquid and fungible of all commodities. So yes, even though consumable commodities seems to have bottomed for gold for the first time since 2001, I expect when the public catches on to this, which should be this year, I hope that the prices of gold and silver, or the purchasing power, I don't even say price, the purchasing power of gold and silver will rise much faster than the purchasing power of other commodities, which isn't really purchasing power. It's more a consumer cost, because other commodities are not used as money. And now finally, I want to go into the bleeding central bank. In this chart, I've seen this before. This is weekly Fed remittances to the Treasury. It reflects their earnings or a loss in the central bank balance sheet. Everything has, almost every week there has been earnings, and all of a sudden, bam, the earnings have turned into a loss. That loss has increased, accelerated every week. Let's zoom in here. Since September, when gold bottomed, actually, or gold and commodities bottomed. Gold actually bottomed in November. I think silver might have bottomed in late September, but very closely correlated to Fed profits here. It continues to fall. Their losses continue to fall, and all of this has to be plugged up by printed money that is literally unbacked by any asset, not bonds, not gold, not even tissues, which would be more valuable than digital dollars, because digital dollars can't even burn them. And it's very bad for fiat currencies when their issuers go bankrupt.
He's very bad.
This is Rafi, the Endgame Investor. If you enjoyed this video, I talked about these bottom convergences in the Endgame Investor last week as a little hint or preview or whatever you want to call it of the type of stuff that I write about at the Endgame Investor. Or you can become my patron on Patreon, where I give a biblical commentary on monetary and economic policy topics. This week, we're going to go into something a little bit controversial: how the Jews became slaves in Egypt and what it has to do with monetary policy instituted by Joseph, the central banker of Egypt. So long, and see you guys soon. I got an interview coming up with Murray Sabrin. It was fun, and you should listen to it.
Up your butt, Jobu.